A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody is doing well. Looking forward to getting us through this week, getting us on top of the major narratives so we know what's moving markets. Just as folks are signing in, don't forget I will be looking through a key medium-term opportunity we have that's just really materialized, and I will be sharing that during the course of the session on the pound yen. We'll also be recapping the recent moves we've seen in the dollar after the better than expected non-farm payroll print on Friday. If you could just let me know that you can see my screen and hear my voice okay, that would be great. If you just joined, those of you just coming in the webinar, we'll be looking at a medium-term sell bias that we have in the pound yen. I'll explain the rationale for that, as well as the technical entries and the risk factors involved. And we'll be just getting on top of the major narratives in both stock markets and for the US dollar post the shift we saw from the Federal Reserve last central bank meeting and what that does mean for markets. Thanks, Pat. That's great. Thank you very much. Screen and sound all right. Just as folks are signing in, don't forget, as we look at this different entries, exits and different instruments, the whole idea of this webinar is not that it's a signal trading service, it's an educational service. You see how I go about trading, making trading decisions, and that can help you in your trading decisions and help you to inform how you go about trading your accounts. We'll be looking at the trade out of the US inflation print. That will be on Wednesday. Don't forget, every Wednesday, 12:30 to 1:30 GMT time, we will be looking at a key trading event, and that's going to be the US inflation print. Growth and inflation are two of the most important metrics, not just for the Federal Reserve, but for central banks around the world. And what is printed on Wednesday will have a big impact in the dollar and yield. So we'll be looking at which is the best currency pair on the day to trade. We'll also be looking at the pound, what's going on after last week's BOE meeting, what's the trade post RBA, the euro yen, a little bit more complicated now, Aussie yen sell bias through next week. We'll be looking at the risks for that. And, you know, where we are with stock market, whether we're in a bear market rally or whether we've put in a bottom. So those are the sort of things we'll be looking at during the session. So don't forget, you can ask questions as we go through the session. I'm going to start with a quick recap, because that's going to be helpful for us, so we just see where we are in markets and what's going on. In terms of today, very light on the trading calendar, so it's just a risk sentiment driven day. We are slightly positive risk, and you can see that the equity futures markets are just pushing higher, Dow pushing up, S&P 500, NASDAQ, DAX, Euro stocks, all pushing higher. China 50 has sort of, you know, managed to cap some of its recent falls. What's going on with the 50 is, from a medium-term bias, we do have an upside bias in the China 50. The central bank in China is cutting interest rates, and China is continually releasing fiscal stimulus to support the economy. But we have seen a global slowdown in the economy. We've also seen a rise in COVID cases, and some more negative COVID news took place out of China over the weekend. And we are seeing a pull back down to this 13,500 region. Now we have a very large hammer reversal bar that a number of us traded long into that 14,500 region. That was the key overhead resistance, but that is still suitable for going long. So the China 50 is suitable for going long from market, stops just underneath that 12,163 region, and you could look for a move back up to 14,500, 1,500. If that breaks, then it's back up to 1,600. So a lot of potential opportunities there. Near term, we're seeing the China 50 move lower. GDP has been revised lower in expectations from analysts due to a number of negative sentiment comments from China's officials about hitting their GDP target. Seems unlikely they will. And that's part of the reason, and they maintain their zero COVID policy. Now, don't forget, you can check out the zero COVID policy on my blog at blog.hycmlab. If you just look at the screen there, you know, do check out. I put a lot of information up here all the time, so you can just follow that anytime you want. I've just put it into the chat box. But it is suitable for buying at market. But remember, stocks just underneath that 1200 region. If it goes lower, we could potentially look for a new opportunity. But that's what's going on with China's 50. The major moves here. Now remember, when a bear market is when stocks fall 20% from peak to trough. So in the S&P 500, you can see that stocks entered a bear market around May of this year, right? So that's when we got peak to trough drop. Now we're out of a bear market when we see stocks gain by 20% from the bottom. So we're here at 3631 roughly. We're about 14-15% up. So is this just a bear market rally? Right, now the key area to look for is looking at a retest of this region here. Okay, so you know, we are not like wanting to buy this, and we're not wanting to sell this at the moment. We need a fresh catalyst to see what's going on with stocks. At the moment, there is concerns because US growth is definitely slowing. That's what brought about the Federal Reserve pivot in their last central bank meeting. They said at the first line of their statement that they're concerned and they're recognizing some slowing growth in the US economy. That brought many investors to think the Fed's pivoting. Now, they may or may not be pivoting, but certainly they're recognizing slowing growth. Now, after the very strong NFP print last Friday, and if you just take a look at the print here, you'll see that the print came in, a very stunning print with the headline going above maximum expectations. It was over 500,000 for maximum expectations. You can see here the print came in, where is it? There, non-farm payroll, headline 528, above the maximum expected 325. Unemployment down 3.5 in line with the low that was expected. That's good. Average hourly earnings 0.5%, just underneath the high expectations. Average hourly earnings year on year 5.2% in line with the high expectations. So a very strong print. And that led short-term interest rate markets to start expecting a 75 basis point hike. And you can see the Federal Reserve here that after that meeting, there's now a 90+% chance of the Fed hiking by 75 basis points in their next meeting on the 21st of September, right? So that in itself, more aggressive Fed hiking should pressure stocks, because if the Federal Reserve's hiking aggressively, that means companies' profitability is harder and they're likely to have to, it's going to cost more for their debt repayments. Folks are going to have less disposable income as mortgage rates rise, and if inflation is also eating into people's earnings as well, then companies' profitability should be hit. So that's the reasons why people aren't thinking this is a bottom. It's still anticipated to be a bear market rally. But truth be told, conviction is neither here, it's neither to the upside or the downside. I would favor selling above buying, but I would need to find a level. The best technical level that I could see potentially selling would be around that 4,250, 4,300 region. Okay, but bear in mind that level is still under that 20%. So we could still have a bear market rally up to that region here, and that's still a bear market. We'd need to get above 20%. So you need to get above that sort of 4,350 region, 4,350 region really, to say that that's more than the bear market rally. But the other thing I would say as a warning, look how steep that COVID stimulus recovery has been. It's much steeper than stocks normally go. So it wouldn't be a massive surprise to see a deeper correction and some, confusing price action given how steep the gains have been. So that's, keeping us on track with the major narratives. Now, gold fell sharply last Friday on the strong jobs print because investors are expecting more aggressive rate hikes, and slowing growth is maybe not so much of a problem. Now, there's a lot I could say about the NFP print, but the key thing to remember is that interest rates jobs data is a late cycle indicator. In other words, by the time you start seeing the jobs market slowing down, recession is normally bitten well and truly. And technically, the US is in a recession now, 2 negative quarters of GDP growth. technically US is in a recession, but the labour market is still very firm, very strong. But that tends to be later down the line you start to see labour market being hit. So if you think about it, companies, they don't, as soon as they see a slowdown in the economy, they don't just instantly fire workers or stop recruiting workers. But you'll see there's been a trickle of major companies who, reducing hiring, stopping hiring, etc., etc. So the drop in gold was expected in line with that move higher we saw in the dollar. Now, if you just take a look here, you see the dollar surged higher, but, right, is this really going to change the market sentiment? At this stage, my view is no, because it's one employment print. Yes, it shows that growth is good, but it doesn't change anything massively. It doesn't mean that the US is suddenly going to avoid, a major recession. So that's why I think we've seen this response in 10-year yields. Yes, 10-year yields moved higher than the NFP, but it just hit that 2.85% region and sold off. So I don't know which way this is going to go, obviously. But the best way to trade this, in my opinion, is to look for those little shifts in sentiment that we see. So on Friday, when we had that very strong NFP print, we knew that was likely to move yields higher. You can see that the dollar yen basically tracks US 10-year yields. If you look at this here, and if you just put like a 10-year yield chart on the US dollar yen, you'll see, look, oh yeah, the dollar yen moves in line with 10-year yields. When 10-year yields fall, dollar yen falls. 10-year yens fall, dollar yen fall. Rising yields, rising dollar yen. Okay, and that works even on those very small time frames. You'll see a very, very close correlation. Falling 10-year yields, falling yen, rising 10-year yields, rising yen. So what do we expect to see, and what did we see? Surging 10-year yields, expecting to move higher. So the way I traded this on Friday is I just took a simple long. Now, took a simple long through market, and I took profit up at that 134.50 region. Now you can see the price moved through into the US session right to that 135 target, and even higher. Look, 135.50. So fantastic run. But you see, I was looking at those near-term highs as an obvious place to take profit. Yeah, and price, if you look on the intraday charts, you'll see that price sort of stalled around that kind of region, sort of moved up to that sort of 134.50 region and just got stalled there. I drop a little bit, probably a lower time frame, you'll probably see it a little bit more. You can just see maybe it felt worse at the time. It just moved up on that 15-minute candle and sort of kind of stalled around. So I took profit up at those highs. And that's it, and I'm going to leave that. I didn't want to keep holding the dollar yen. It's not like it's fundamentally changed the outlook for the Fed. It's not like the Fed pivot is definitely off, but it was just enough to say, well, I want to see what the next data points that are coming in from the Fed are like. So that's why, and that's how I traded that dollar yen. That is, in my opinion, the best way to be trading these top calendar events right now, because this week we have, so there's nothing much today and there's nothing much tomorrow. But Wednesday, we've got the US core inflation print. Now remember, what investors are expecting is they are expecting the Fed to keep hiking interest rates as long as inflation is high. Now the Fed has basically said that they want to bring inflation down. It's their main goal. But in their last meeting, they said they also were, obviously will be moving to a meeting by meeting basis. So do see my reports. If you just look at the HYCM blog and you go to market fundamentals and you go to central bank watch, I deal with this in detail, and you can just see here on the 1st of August, I unpack the Fed's response, and basically, is the Fed recognizes slowing growth and sends the US dollar lower. Okay. So that is what happened. That's why I was expecting dip buyers of gold and silver, and that moved very nicely higher from that outlook. Now, if inflation remains high, so say inflation comes in, we'll deal with this on Wednesday properly, above 9%, that will mean we'd expect the Fed to keep the pressures on the Fed to keep hiking interest rates. That should keep US 10-year yields supported and should push the US dollar Japanese yen a bit higher. Okay, we expect the dollar strength, and so we'd expect something like euro US dollar weakness, but dollar yen upside. Now, the best opportunity would likely come is if we see inflation showing peak. So if the inflation comes in year on year, headline sub 8.5, and the core comes in sub 6, right, for the year on year headline, expect the dollar to sink lower, and then I expect good upside in gold and silver because real yields will likely drop. We'd expect 10-year yields to drop because there'll be less pressure on the Fed to hike, and if inflation drops, that also takes some of the sting out of rising real yields. You'd expect real yields to potentially fall as well. So that should be, depending on what happens with the 10-year yields, obviously, but you should see some upside gold, upside silver, downside dollar yen. We'll cover it fully on Wednesday. Do come along so we get totally ready. Thursday, we've got core PPI data. Again, that will be important just to see what the price pressures are in the US. The more signs that falls, the better. And this is jobless claims. Now, that has been rising recently. We've seen a string of jobless claims increasing. And the forecast is 263,000. If that comes in like above 355,000, then we'd expect 10-year yields to fall, dollar to fall, gold upside, silver upside, dollar yen downside. That will be the growth story. Remember that jobs is a late cycle indicator, but if we start to see jobless claims increasing, it's a sign that the US economy is slowing. So the Fed mentioned a trend they'd seen an increase in jobless claims. So if they see that again, they'll be sensitive to this data. And if we see a rise in the initial jobless claims, in other words, more people are registering work. If we see continuing jobless claims rise as well, above market maximum expectation, 10-year yield downside, expect dollar gains, dollar losses, dollar yen losses, euro US dollar gains, but gold and silver should be a good expression of that. On Friday, we've got consumer sentiment. Now, this will be very important. Some analysts prefer this consumer sentiment as the earliest indicator of a recession, and that's because consumers are more responsive and more worried about rising inflation and economic conditions than companies, because a household is more sensitive to the ebbs and flows of the economy. So when consumer sentiment is dropping, it's a good indication that a recession is potentially, getting tighter grip. And the US, of course, is technically in a recession. So what we're looking for here is, because the consumer expectations are expected to come in at 48.9. So that is in contractionary territory. It's expected to be higher than the previous reading of 47.3. If that drops again below 46, then expect downside in 10-year yields, downside in the dollar, downside in dollar yen, upside gold, upside silver. Okay, that's definitely something to be looking out for. Potentially maybe some upside in the Aussie US dollar as well, because the Aussie US dollar is very stretched in its short positions. CFTC positioning showed another increase in asset managers and leverage funds shorts. Some of that looks a bit stretched now. So if we got a lot of dollar weakness, then we could look for potentially some Aussie US dollar gains, particularly if you've got any good news out of China and any good news about the COVID zero policy. Remember the main story now, it's all about growth. Is the US slowing its growth? Is it falling behind? And if it is slowing growth, if that is getting worse, then it will mean the Federal Reserve will have to pause their rate hiking cycle. So we should see aggressive interest rate expectations start to unwind. If you look at the dollar index, I can show you how this has been playing out. Like, look at the dollar on a zoomed out chart from the start of the year. What you can see from the start of the year, the dollar's been gaining. Why? Two reasons. The dollar's been gaining, first of all, on the US aggressive rate hike expectations. That's been pushing the dollar up. It's also been slowing global growth. Dollar's a safe haven. So the dollar's been having two reasons for gaining. One, slowing global growth. Two, aggressive rate hike expectations. What we're now seeing is the dollar just sort of retesting this sort of key support level down at this sort of 105 region. Dollar tested that level, find some resistance and pushed higher. Now, what we're looking at here is, can the dollar keep gaining or will it fall lower? Now, it's likely to fall lower if we price out further rate hikes from the Federal Reserve. So in other words, if the Federal Reserve is less likely to hike interest rates, we're likely to see the dollar move lower. So the dollar moved higher after that NFP on Friday because it was a very good print. So it means the Fed could hike interest rates by 75 basis points and the dollar gains. But remember, it doesn't change the overall concerns about growth. So that's why it wasn't a move to chase. The best opportunity will come from a situation where we start to see aggressive rate hike expectations being priced out of the market. Now, let me show you this in the latest CFTC report. If you just look at this CFTC report here, let me just see, you'll see that, look at the dollar. Let me just show you. Where's dollar positioning? Right here, you can see dollar aggregate positioning. It's quite near the 80 percentile long region. And that means when it's in the 80% region, generally speaking, you've got an overbought condition. So we're quite close to being heavily overbought. Now, remember, you can't just get into an overbought position and short something, or get in an oversold position and buy something. Like you see, Aussie dollar is sort of in an oversold position. Shorts increased again last week. Again, that should be that's not a reason just to buy the Australian dollar. You need a catalyst. Similarly, just because the dollar is up near its highs doesn't mean that's a reason to sell the dollar, but we do recognize it there, okay? And we just keep our eyes on it. And you can see here, for instance, with the Aussie dollar, look, it's in a stretch short position, okay? So below that region, the shorts are definitely stretched. So if we get any good reason to buy the Australian dollar, bang, we want to take it. Okay, so it could be the end of zero COVID policy, you know, a reflationary outlook for the globe, a big surge in copper demand or iron ore demand, something like that could be a good reason to suddenly go long the Australian dollar. But at the moment, the Australian dollar is obviously sold for a reason, and if you look at the my blog, you'll see that the RBA has moved to a meeting by meeting basis, just like the Fed. They're just a little bit more reticent now. It's a bit of a dovish meeting that we saw out of the last BOE meeting, not BOE, RBA meeting, and we did see a more dovish BOE meeting as well, which is a good time to move on to it. Now, look at the BOE, very dovish meeting. It was always about the growth forecast going into the BOE, and they have revised growth lower, inflation higher, up to 13%. The recession now for the UK has been brought forward from 2023 into 2022. It's also expected to last for 5 quarters. The UK energy crisis is projected by some analysts to be worse than the energy crisis from the 1970s. Furthermore, the GDP is expected to remain negative 2023-2024. So, in other words, the UK is heading into a very tough financial time. This means the pound is a sell on rallies higher. So we do have a negative outlook for the pound medium term on that basis. Now, if you also notice the yen, you can see that the yen tends to see a period of seasonal strength around this time of the year. Okay, and you can see it's very strong, this yen seasonal strength. It's same across yen pairs. You generally see yen strength around this time of the year. So we are in a period of seasonal yen strength, Aussie yen, pound yen. You can see it with the euro yen. All right, same again, also pound yen has this negative bias. So given the fact that we have a sell bias for pound yen, now we're towards the end of that cycle, towards the end of that technical pattern, but we still do have a negative pound yen bias. We've got the Bank of England having tilted to a more dovish outlook. So that does mean I do like the pound yen selling at market. Now you can see here, we've got this near-term trend line, 1, 2, potential trend line. We've had a retest there. I think you can sell at market. Either stops just above 164 or more conservative stocks above 166. I like selling at market with stops just above 164 because top stops are nice and tight. We've got that sharp sell-off from the Bank of England. If you take a look at it on the intraday chart, see. So in other words, if we go above that 164 region, we've got that nice R1 pivot zone. So if we actually go above that level, then I don't want to be in the trade anyway, because where's the pound yen going to go to? It could continually keep moving up to like 166, maybe 168. I'd reconsider. So I can define my risk quite nicely, and then you've got a potential play back down to that 161 region, just down below here. You've got a nice support region you could potentially look for price to move into. So the risk reward's good. You've got a nice area. We've got seasonal yen strength. We've also got reasons for the pound to sell off after the Bank of England's more dovish outlook from last week. The only downside, obviously, is if we start to see yields move higher, then we can see the yen weaken. And if yields keep moving higher after the good NFP last week, then we could see the pound yen take out 164. Also, if we had anything more popular or more optimistic for the pound, we've got Rishi Sunak and Liz Truss both promising billions of pounds for the UK economy that could support the pound in the near term. So there are risks with this trade, but I just like the fact that, broadly speaking, medium-term bias is downside for the pound yen, and risk can be nicely defined just above that 164, above that R1 pivot point for today. Okay, folks. Let's go take a look at different questions. Interest rates in USA trickling up. Yeah, that's right. What CN is saying here in the Q&A is, we've had that sort of decent NFP print from last Friday, and that's just boosting expectations that the Fed will be able to be more aggressive in hiking interest rates. And that's why we've seen interest rates expectations gain. And now, since that NFP, we now got 90% chance of a 75 basis point hike. Now, as I said, I'm not buying that the Fed pivots off. I'm not even necessarily buying a Fed pivot. All I'm saying is I want to respond to the data as it comes in and trade those little shifts. That's what I'm trying to do. Yeah, interest rate differentials favoring the US dollar. Exactly. That's why we've seen a little bit of dollar strength. But remember, CN, the bit that's a bit questionable is we saw that move, didn't we, in 10-year yields, but 2.85% wasn't able to be broken on the Friday, right? So look at that level. If that level breaks, then that's sort of more optimistic for that US dollar interest rate differential upside on a more aggressive Fed now expected in September. If it stays underneath that level, then it's bond markets telling you, actually, we're still worried about growth. Growth at the moment is going to be more important than inflation in like this week for now. But obviously both are important and both have the potential to really move the market. Yeah, okay, Massey. I noticed New Zealand dollar inflation expectations ticked down a bit. Around 3% inflation is still relatively low inflation. Would an Aussie New Zealand dollar long make sense, given the fact that the RBA may still hike, albeit at a slower pace, right? The outlook here, right? So let's look at them both. Great question, Massey. So the RBA, they've moved to a meeting by meeting basis, okay? So we're also seeing shorts very stretched in the Australian dollar. So the outlook is that the Aussie's been quite heavily sold. So could we see a retracement in the Australian dollar? Well, yeah, we could potentially. Now, interestingly, if you look at currencies today, see the Australian dollar is leading the pack to the upside. Now there isn't an obvious catalyst for that that I can see out there. You can see Aussie just leading the pack to the upside, right? CAD, New Zealand dollar on that risk-on tone as well, but Aussie just outperforming and outperformed early in the session, right? Even when the CAD and New Zealand dollar were a bit flatter. So, is there a bit of Australian dollar buying in the market? Yes, there is, but is that on the fact that the RBA may still hike, albeit at a slower pace, compared to the New Zealand dollar? Not necessarily, because if you look at the RBNZ, now the RBNZ are meeting 17th of August, so they're meeting in 9 days' time, okay, Massey? So if you just take a look here, I should have my last look, right? The RBNZ was sort of starting to give hints at slowing growth in their last meeting. So what I'm expecting, and especially if inflation expectations are dipping down, then it means the New Zealand dollar, I'm expecting them to turn a little bit more dovish next week as well. So you put that all together, then the Aussie should be falling against the New Zealand dollar, but then on the next interest rate meeting, you'd expect the Aussie to gain against the New Zealand dollar. So an Aussie New Zealand dollar long can make sense, but for different reasons than you've mentioned. All right. So I think if I was going to take an Aussie New Zealand dollar long, I would take one just before the meeting. Now my rationale is like this: if you look at the central banks, look what happened. So first of all, we had the Fed. They recognised slowing growth, didn't they? It sunk the US dollar. They went to a meeting by meeting basis. What did the RBA do? The RBA met next, and they moved to a meeting by meeting. And hear what it said here: the Federal Reserve is like the Pied Piper of a central bank. When the Fed takes a change in policy, the implications trickle down to other central banks. So that's why I expect the RBA to be more dovish. Were they? Yes. Oh, and then who meets next? The BOE. What were they? They were more dovish. Now, who's the next central bank meeting? Let's just take a look at our calendar, and we can see, lo and behold, I'm pretty sure it's the RBNZ. Yeah, next interest rate meeting, RBNZ, 17th of August, right? And as things currently stand, expectations are 60% for 75 basis point hikes and 100% chance for a 50 basis point hike. So expectations have gone up in a week that the RBNZ will hike by 50 basis points. So there is a little bit of New Zealand dollar strength relative to the previous week from the stir markets. So that would favour Aussie New Zealand dollar selling. Now, before that meeting, like, I would be quite happy, to sell the Aussie New Zealand dollar if we move higher into this overall resistance level on the daily chart, right? So, that's not surprising. We'll find some sellers from that region. And you see, I've got that region marked. That's why I'll be looking at selling the Aussie New Zealand dollar. We're seeing a little bit of moves. Now, I'm not chasing this now, Massey, because I don't see any reason to. But, do I see the RBNZ turning more dovish next week? Yeah, I do. So I would expect the Aussie New Zealand dollar to be drifting lower rather than higher. But ideally, I want a catalyst. You see what I mean? Ideally, I want a catalyst. I hope some of that makes sense, Massey. I like your thinking. I like you trying to think about those interest rate differentials. The thing is, always look at the bond yield differentials between the Aussie 10-year and the New Zealand 10-year. You can see them here, and you see the bond yields pushed up higher, and they've dropped lower. Now, if those bond yields keep pushing up, then you can expect that to keep moving. But I'm expecting these yields to eventually move back lower, and I'm expecting the RBNZ to follow the Fed, etc., and to be more dovish. Yeah, thank you, Massey, and thank you, CN, for your comments, both of you. Always helpful to have a specific question to get stuck into. So thank you both. Don't forget that pound yen bias. That's not bad. Quite a nice little outlook there in the pound yen. There's a bit of sell bias. Don't forget the risks that are involved. It's obviously not trading advice, but it is a trade that I entered earlier this morning and just stopped about 164. Today, targets, 161.50, then 161 are reasonable. Folks, take care. and look forward to being here on Wednesday. Hope you can make it. Thanks everyone now. Goodbye.